morning, Mr. Wasiu.
Good morning. Yeah, you are welcome to another section of the class today. So in our last class, we talk about the computation relating to capital allowance. So where I told us that we still have to look at scenario so that is where we are going to start from today, for treatment of capital allowance on assets acquired on hire purchase. So basically, when they say hire purchase is an agreement between two parties, between the buyer, between a seller and a buyer, where the seller agreed to transfer possession. Look at that word, possession of the property to the buyer until the payment of a final installment, in which after the final installment, the ownership of the property becomes that of what? That of the buyer. As at the time of payment, the buyer is yet to become the owner of the property. So because the buyer is yet to become the owner of the property, but where the property is being used for the purpose of trade or business, the tax law gives the buyer the right to claim capital allowance on what? On that asset. And the capital allowance will be claimed based on what? How the payment is being made. It is very simple. Because you are still going to end up being the owner of the asset, the law gave you a right to claim capital allowance on that asset. A good example of all those things that is usually acquired on hire purchase are what? All these were motorbike, all these were commercial buses, corofe. So they are usually acquired on hire purchase. So after the payment of the final installment, the buyer will become the owner. So because the government don't want to make a situation whereby the taxpayer will be what? We claim relief for what he does not suffer or he does not use for. Because taxpayer can be very funny in the sense that, assuming the government gives the buyer the right to claim the capital allowance at once at the beginning of the useful life. So the buyer can decide to fail in the payment of that installment. And when the buyer fail in the payment, the seller is going to collect back the asset. Meanwhile, the buyer will have enjoyed the capital allowance. So that means that it's going to enjoy capital allowance for what it does not suffer for. So in order to make it to be unique and to be simple, so the acquisition or the claim for capital allowance will be what? Will be obtained in line with what? In line with how payment is being made. So in order to understand this particular topic very well, there are some terms that we are going to be talking about. The first one is what? IRR. The IRR. So IRR. So that is what the seller, the original owner of what? Of the asset that is being sold on hire purchase. So the owner of the asset, that means the person that is selling the asset. So the name for that person in line with what the hire purchase term is called IRR. So that is what the seller of the asset. Then we have the IRE. The IRE is the buyer. So the person upon which your possession, the person in which you are transferring the possession of that asset to, is called the IRE, who is also the buyer of the asset. Then we have a cash price. So cash price is the price at which the asset can be acquired or obtained from, if you are not buying on hire purchase. Assuming you want to buy that asset on cash and carry, how much is the price of that asset at the market? So that price is called the cash price, which is the cost of buying the asset if you are paying immediately. Then we have so that cash price can be written as CP. So simply written as CP. Then we have hire purchase price, which is the HPP, which is the price you are paying for for buying that asset on what? Hire purchase agreement. Because you are not going to pay at once, the seller is going to add what? Additional cost to what? To the cash price of that asset. So that additional cost that is being added plus the cash price, the addition of the additional cost and the cash price is what is called the hire purchase price, which is what the total amount you are going to pay to buy that asset on what? On hire purchase. So which is what? The price that is charged by what? By the seller to what? To the buyer. So which is what? The addition of what? Both the cash price and the what? Hire purchase interest. We now have what? The hire purchase interest. So the hire purchase interest, that is the what? The charges or the additional cost that is going to be what? Suffered by what? By the buyer for buying the asset on what? Hire purchase. The additional cost that is going to be suffered by the buyer for buying the asset on hire purchase. So if you are, because you are not paying for cash immediately, as I said, the seller is going to add what? Additional cost, because you are going to spread the payment. That additional cost that's being added is called hire purchase interest. So we need to note that because we want to calculate capital allowance, and this capital allowance, so this capital allowance is available on what? Is claimable as a relief for what? For the cost that is being incurred by what? By the buyer. So in essence, so the capital allowance, this hire purchase interest, is usually an allowable expenses for the computation of adjusted profit. For the computation of tax liability, that hire purchase interest is part of the amount they are going to allow you to remove when you are computing your tax liability. So because you are going to use it, you are going to claim it as an allowable expense, it's not going to be available for what? For capital allowance claim. Because if you are going to claim it as allowable expenses, if you not claim it for capital allowance claim again, it will become what? Double. In order to avoid the double claim, because they are going to allow it as what? Allowable expenses. So the hire purchase interest is not going to be what? It's not going to be available for what? For capital allowance claim. So that means when you are computing, when you are calculating capital allowance for asset that is acquired on what? On hire purchase, there is need to eliminate what? To eliminate hire purchase interest from your computation, because that will not be available for capital allowance claim. Then this our hire purchase. So when you are buying an asset for on hire purchase, it is expected that you are going to what? Make what? A deposit. That deposit you make is what? Is called what? Initial deposit, which is usually paid at the date of the agreement. That deposit you are paying is to sign what? The agreement, to what? To seal the agreement, to show that yes, you are what? You are ready to what? To buy that asset on hire purchase. So that first payment you are making to seal the agreement is called what? Initial deposit, which is usually paid on what? On the date of the contract, on the date of the agreement. So you may not be told, but they will tell you that an initial deposit is paid. So that initial deposit is going to be paid on what? On the date of the agreement. After paying the deposit, but that because that deposit is not what? Is not the final payment for what? For that asset. So they are now going to spread that that's the remaining amount on what? On certain basis. That amount you are going to be paying at various intervals is called what? Instrumental payment. So we have what? Instrumental payment. So which are what? The subsequent payment that will be made by what? By the IRR, by the buyer to the seller at what? At regular interval. So this instrumental payment is going to be made at what? At regular interval, based on what? On the agreement between what? Between the buyer and the seller. It can be, if the agreement can be that the payment should be made on what? On weekly basis. It can be, it should be made on what? Monthly basis. It can be on what? On quarterly basis. And it can be on what? On biannual basis. Depend on what? on the nature of their agreement. So, but that money that will be paid at regular interval is what is called instrumental payment. So the reason why the seller may not be allowed to claim capital allowance. So the law stated that the seller of that asset will not be allowed to claim capital allowance on that asset. So what is the reason for that? Because one of the reasons is that because the buyer is the one utilizing the asset for the purpose of trade. The seller is just the owner. Is not the one using it for the purpose of trade. So in that case, it's not going to be allowed to claim capital allowance on that asset. Also, the lessee, the buyer, is paying for the cost of the asset on instrumental basis. Because the buyer is also going to be the owner of the asset as at the end of the payment. And that payment is being made on instrumental basis. So because he's still going to be the owner, so the seller is not going to be allowed to claim capital allowance. The lessee bear the economic cost. So the cost of the asset is borne by the buyer. So that is the reason why the seller will not be allowed by law to claim capital allowance on that on the asset that is acquired on instrumental basis. So what are now the procedures that are involved to compute capital allowance when the asset is acquired on hire purchase? So what are the procedures to be adopted? So one of the procedures is to identify and calculate the hire purchase price. Identify and calculate the hire purchase price. So identify and calculate the hire purchase price. So identify and calculate the hire purchase price. So when you are not giving, in a situation whereby when we are not giving the hire purchase price, we need to identify and also to calculate the hire purchase price. So the hire purchase price can be calculated in various ways when we are not giving. So it can be calculated in various ways. Determination of hire purchase price, as I said. So when you are not giving, the hire purchase price can either be, I told you, can either be the addition, the hire purchase price can be the addition of our cash price plus the hire purchase interest. The hire purchase price can be addition of cash price and the hire purchase interest can give us the hire purchase price. Or hire purchase price can also be gotten as initial deposit plus total installments. So the hire purchase price can also be the addition of the initial deposit and the total installment. So the first thing for us is to identify and calculate the hire purchase price, which is so that is if you are not giving. But if you are giving that, so you need to so you just state it, indicate it. So then we have that's why you said identify or calculate. So when you are not giving, you calculate. When you are giving, you identify it. Then you now determine the cost price of the asset, which is the cash price. You determine the cash price of the asset. So the cash price, as I said, so is the cost of acquiring the asset when you are paid for the asset immediately, or when you are not buying on hire purchase. What does it cost? Then you now identify the date of the agreement. That is, what is the date that agreement is being signed, and pay special attention to deposit and instrumental date. I told you that the initial deposit will be paid on on the date of the agreement. You need to pay attention to that date and the date that the instrumental payment will be made. Then identify the deposit and instrumental payment made. You need to know how much will be paid out at the deposit and on this instrumental payment. Then determine the relevant year of assessment. and related basis period. Because you are going to be paying that money on what? On interval. It is possible for the buyer to pay what? To pay certain amount of money for a number of years. If you are paying on a monthly basis, so that means in a year you are going to pay what? In 12 times. So depending on the stream of payment, you identify what? The payments that what? That made that are what? That relate to what? The related basis period. Then identify and add all payments falling within the same basis period. For the same basis period, you identify all payments that are in that same basis period. Then you introduce what? Each new asset as new asset for capital allowance computation. Then each new asset will be introduced for what? As each payment will be introduced as new asset for what? For capital allowance computation. So when you are calculating the capital allowance, any asset that fall within a year, any payment that fall within a year will be accumulated together for what? For capital allowance computation. So how do we now go by what? By computing this basis of what? Of capital allowance. As I told us, so determination of instrumental payments. Determination of instrumental payment. We already know that our initial deposit, total installments will give us the what? Higher purchase price, which will give us the higher purchase price. If you less the higher purchase interest from this higher purchase price, if we less the higher purchase interest from this higher purchase price, that will give us what? The cash price. So we need to get rid of the higher purchase interest from the higher purchase price. Why? Because we have already stated that what? The higher purchase interest will be what? An allowable expense. So it will not be what? Available for what? For capital allowance claim. In that case, so we need to what? To eliminate what? The higher purchase interest. So after eliminating the higher purchase interest, so we now need to calculate how much are we going to pay on what? On instrumental basis. So what is the amount that is payable per installment? So how much is payable per installment? So we need to get what? Amount payable per installment will be equals to total cash price. No, okay. You know that part of this cash price, yes, part of this cash price, out of this cash price that we have, this cash price that you are supposed to pay, you are going to pay a certain amount of money, which is what? You less what? Initial deposit. Initial deposit will be paid as amount as part of this cash price. So this will now give us a balance of cash price. So this balance of cash price is what we are going to want. We are going to spread for the number of years. So amount per installment will now be equals to balance of cash price divided by, so you now divide it by what? number of installment divided by number of installment. So you'll be told that the installment can be what? 12-month basis on what? Whether annual basis or monthly basis. So just look at how many installments is he going to pay. Divide it by what? By the number balance of what? The cash price. So that will give you what? How much the what? The taxpayer, the buyer, is going to pay per what? Per each installment. So after getting this amount is going to pay per installment, it is this amount that you now spread for what? For the available number of installment. So based on what? Based on the given what? Information. So that amount will be spread on what? On the available number of installment. So the computation of what? Of capital allowance for asset that is acquired on hire purchase will be based on what? On the stream of payment. It will be based on what? How payment is being made. So that's what we mean by the stream of payment. So let us look at an illustration to analyze that. So we have a question, which is what? Question number 4. Question number 4. Any question? Any question? Before I proceed further. Okay, question number 4. So we have what? Koshemani, Nigeria, Koshemani Limited, acquired a motor vehicle. Koshemani Limited acquired a motor vehicle with a higher purchase price of 300,000 naira on 1/1/2014. The higher purchase interest rate is at the rate of 10%. The details include an initial deposit of 100,000. Balance was payable in 4 equal installments in 6-month interval, with effect from the date of the agreement. The accounting date of the company is 30th June annually. All installments were paid as at when due. You are required to compute the capital allowance claimable up to the end of the asset life. If you look at this now, you can see you'll be told in the question that the asset was acquired on hire purchase. So motor vehicle, it was acquired on hire purchase. So that means the principle of what? Hire purchase provision must be adopted before you can calculate what? The capital allowance. And because it's not going to pay at once, so the capital allowance will also not be what? Provided to the taxpayer at once. So in order to compute this capital allowance, so we need to analyze the information provided, given to us. So we have the question. Question 4. Koshemani Limited. So we need, before we can compute the capital allowance, we need to analyze the information given to us. We need our workings to analyze the information given to us. So the first one, I need to state out some information that will be useful. So first one, we have higher purchase price. From the question, so let me go back to the question. From the question, we are giving higher purchase price. The question gave us the higher purchase price. If you are not giving, you are expected to add up what? The initial deposit plus what? The total installment. So we are giving the higher purchase price here, which is what? 300,000. So you state that. Then we are also giving the higher purchase interest. Let me indicate that as well. It's 10%. Higher purchase interest is 10%. So we are giving the higher purchase price to be 300,000. So we have it as well, 300,000 naira. So we are also giving what? The higher purchase interest to be equal to what? 10%. 10%. Don't forget, we know that our higher purchase price is equal to cash price, minus higher purchase interest. From here, we can get our cash price. Our cash price can simply be, if we collect like terms, will be what? Higher purchase price minus hire purchase interest. From there, I can get my hire purchase, I can get my cash price. So from there, that means cash price will be equals to hire purchase price minus hire purchase interest, which is simply hire purchase price, which is what? 300,000 less hire purchase interest. We are told to be what? 10%. So you now calculate 10% of the hire purchase price. So 10% of 300,000 will give us how much?
30,000.
Will give us 30,000. Thank you. So that will give us what? 30,000 naira. So the resulting figure will give us what? The cash price. So it is this cash price that will be available for what? For hire purchase, for capital allowance computation, which is what? 270,000. So this cash price will be available for what? For capital allowance claim. So it will be available for what? For capital allowance claim. Then also this cash price so the cash price is stated below. So we have it as well. Cash price is equal to 270,000. From this cash price, this man is going to pay less deposit. He's going to pay deposit of. So let's go back. How much?
100,000.
Yeah. So let's go back to, you are told that the details include an initial deposit of 100,000. Balance was payable in 4 equal installments. So he's going to pay initial deposit. So you less the initial deposit of 100,000. So this will be what? Balance of cash price that will be payable on what? On installmental basis, which is how much? Balance of cash price, which is how much?
170,000.
170,000. So this 170,000 now is what is now going to be spread on what? On installment. So you now need to calculate how much per each installment. How much per each installment will be what? Balance divided by what? Number of installments. So we have it as what? 170,000 divided by how many installments did they say is going to pay?
4.
So they say it's going to pay in what? 4 equal installments. So divided by 4 equal installments in 4 times divided by 4. So that will give us what? The amount per each installment, which is how much?
42,500.
30 what?
42,500.
42,500. So after knowing that it's going to pay 42,000 on at each installment, we need to determine how is this amount going to be paid. How is this what? Amount going to pay. We need to determine what the stream of what? Stream of payment. So the next working. So working 4. This is working cash price. So this is working 4. Then working 5. So which is what? Stream of installments. So how much are we going to work? How are we going to spread? How are they going to spread this payment? That's what we mean by what? Stream of what? Installment. How is this payment going to be spread? So in order to spread the payment, so we need to tabularize it to be able to analyze the payment one after the other. So I'm going to tabularize it. So I want to tabularize the payment. I have the details. So the details, I have the date of payment. I have the amount. After the amount, I have the basis period. I have the basis period. I have the basis period. I have the total amount. Then I have the year of assessment. So all this information are what I need to analyze the payments. From the information given to us, from the information available to us, stream of payment, total amount. Then we have what? Year of assessment. From the information available to us, this man is going to pay what? The first thing, initial deposit. He's going to pay an initial deposit. What date is he going to pay that initial deposit? Who can remind us? I told us that the initial deposit is paid on what? It's paid on what? On the date of the agreement.
The agreement.
On the date of the agreement, which is as at when? 1/1/2014.
2014.
2014. 1/1/2014. How much is he going to pay?
100,000.
100,000. 100,000. After that, after paying that, so I'll come back. He's going to pay what? First installment. In which month? In the next what?
July.
6 months. 6 months.
Yes.
6 months to 1/1/2014 will be when?
July.
June.
6 months.
It ends in
First
June.
of June.
First of when?
June.
Which date
The
now?
next 6 months will be July.
July. 1st of July 2014.
Next 6 months will be what?
1st of
30th
June.
30th June 2014. 2014. It's 30th June. Oh. If you say July, that is 7 months. Oh. July is.
Okay.
How much is he going to pay per each installment?
42,500.
42,500. After the first installment, he's going to pay what? Second installment. As at when? The next 6 months. Which should be when?
31st December.
31/12/2014. How much?
42,500.
42,500. After that, he's going to pay what?
30th
Third installment. Third installment. As at when?
30th June 2015.
36/2015. How much?
42,500.
42,500.
Then he will now pay. They said 4 times. 1, 2, 3, 4. He will now pay what? Final installment. As at when?
31st December 2015.
31/12/2015. 2015. How much?
42,500.
500. So this payment now, you need to get what? The basis period that will be what? That this payment is going to fall into. Don't forget, they have told us that the accounting date of this taxpayer is as at when? So let me indicate it here. Accounting date is as at when? What's the accounting date? From the question, we are told the accounting date is when? Accounting date of the company is 30th June.
Okay.
Let me go back to the question. Accounting date, the accounting date of the company is what? 30th June annually. So accounting date is what? 30th June annually. Accounting date is what? 36 annually. So if I have an accounting date of 36 annually, and I want to get a basis period that is going to fall on this date, on 1/1/2014, based on this accounting date, who can tell me what is going to be the basis period that this date is going to fall into, in line with the accounting date of 30th June annually?
That's July 2013.
1/7/2013 to when?
To 30th June 2014.
36/2014. Thank you. It will be what? 1/7/2013 to 36/2014. In line with what? With the accounting date. In line with the accounting date. For this one, I have 36/2014. What will be the basis period?
1st July 2013
30/13 to when?
to 30th June 2014.
36/2014. If I have 31/12/2014, what will be the basis period? In line with the accounting date.
1st July 2014
1 July 2014 to
30th June 2015.
36/2015. So this date will fall, this date of payment will fall in this one basis period. Also for this, what will be the basis period?
1st July
1st July
2015
2014.
2015.
2014
to 30th
to
June
36/2015.
2015.
So what about this one?
1st July
2014.
2014.
2015
2015
to
to
30th June
2016.
2016.
In line with what? With the accounting date. After you have done this, you now look for any of these payments that fall within the same basis period. Anyone that fall within the same basis period, you are going to add them together. Take note of that. Anyone falling within the same basis period will be added together. If you look at this one, this basis period, this first one and this one is the same, Abi?
Yes, sir.
So this payment will be added together as total amount. So that means this one will give us what?
142,500.
If you look at this one too, this one and this one are also what? The same basis period. That means they will fall in the same year. So you are going to add the two together as well. 42,500 plus 40, that is what? 80 what?
85,000.
85,000. Then this one is a different one on its own. We have a 42,500. So this basis period now, this payment, you now use it to determine the year of assessment that you are going to start claiming the asset. If I have a basis period that is ending on 30/6/2014, what will be the year of assessment? A basis period that is ending on 30/6/2014. What will be the year of assessment?
2015.
2015. Preceding year basis. Don't forget. If I have a basis period that is ending on 30/6/2015, what will be the year of assessment?
2016.
2016. A basis period that is ending in 30/6/2016, what will be the year of assessment?
2017.
2017. So that is how to determine what? The basis period, the tax year that you are going to use for what? For computation of what? Of capital allowance or for asset acquired on hire purchase. So after you have done this, you can now what? Compute your what? Your capital allowance. So we have the name of the company, Koshe Money Limited, computation of capital allowance for. So when you have capital asset acquired on hire purchase, the examiner will only give you only one asset. Because the procedure involved is tedious, the examiner will not give you more than one asset because you have to spread the payment. So you state the asset for what? For relevant for motor vehicle for relevant year of assessment. So in the case of motor vehicle, so when you want to compute capital allowance for motor vehicle, you have in the tax law you have annual allowance. So what is the annual allowance for motor vehicle? What's the rate of annual allowance for motor vehicle? For capital allowance, annual allowance for motor vehicle based on NTA. What's the rate of capital allowance? Who can remind us?
25%.
25%. So they said 25%. So 25%. Then we have the total. We have the total. Then we have nominal value. So from your computation, it has been established that your capital allowance will start. You start claiming capital allowance from where? 2015. 2015. So you bring the year. So you bring the year from 2015. So you bring the year 2015. So you have what? For that year, you are going to bring all the assets that you introduce, the total cost that you introduced here, that was paid here, which is how much? 142,500. So you are going to introduce that amount as what? As cost. How much?
142,500.
500 under the rate. This 142,500, you calculate what? The annual allowance on it. Annual allowance on it. So when you are calculating, you also need to be vigilant to look at your number of months in the basis period. If we come to this basis period, how many months is in this basis period?
12
months. 12 months. So that means there is no proration. We are not going to prorate. So simply, our annual allowance here will be what? 142,500 divided by what? Useful life, which is how many years? Without
4 years.
4 years. So that will be 142,500 divided by 4. That will give us what?
35,625.
35,625. So you take it to the total column as what? 35,625 as what? In 2015. After that, after 2015, we have the next year to do 2016. In 2016, you have what? Tax written down value. How do we get our tax written down? That will be what? Cost minus what? The annual allowance.
Annual allowance, yes.
Cost minus annual allowance will give us what? Tax written down value.
100.
Cost minus annual allowance will give us what? Tax written down value. Which is how much?
108,875.
107.
106.
875.
Yes.
In this 2016 now, you now go to your working. Did you make any payment in 2016? Yes. How much?
85,000.
85,000. So that 85,000 will be introduced as what? As a cost. So you have what? 85,000. For this asset, you are going to calculate what? Annual allowance in that year. Annual allowance will now be, to calculate the annual allowance, it will now be what? Addition of this plus this, 106,875 plus 85,000, divided by what? The remaining useful life. So let me work it out. 2016 annual allowance will be equals to 106,875 plus 85,000 divided by the remaining use. So which is what? Total useful life that you are supposed to claim this asset is how many years? 4 years, Abi?
Yes, sir.
Divided by 4 minus, before this 2016, how many years have we claimed this annual allowance on this asset?
1 year.
1 year
2 years.
minus 1 divided by 4 minus 1, which will be what? Which will be
3.
106,875 plus 85,000 divided by what? Divided by 3.
3.
So that will give us how much?
63,958.
90.3.
63,958.
58.
63,958. So you go to your computation.
So you wrote
9.
858.
9.
Is 958.
958. So annual allowance will be
63.
958. So you go to the total column. Under our total column, we have a 63,958. So after 2016, we go to 2017. In 2017, we are going to have a tax written down value. Our tax written down value will be this 106,875 plus 85,000 minus 63,958. Will give us the tax written down value.
127,917.
127,917.
917.
127,917.
917.
In this 2017 also, you go to your computer. Was made in 2017. Yes. Abi? How much?
Yeah.
Look at it.
42,500.
42,500. So that payment will be brought as what? As a new cost. So we have what? 42,500. So after bringing the payment, you now calculate what? Annual allowance in that year. Annual allowance will be what? Tax written down value plus this divided by what? Remaining useful life. So 2017 will be equals to 127,917 127,917 plus 42 plus 42,500 divided by 4. Yeah, divided by 4 divided by 4 minus 2. So which is divided by 2. So that will give us how much?
85,209.
85,209. Yeah? How much?
85,209.
Okay, 209. So 85. So that will give us 85,209. So annual allowance will be in jacket 85,209. So under the total column, we have what? 85,209. So in 2018 now, we now have what? Tax written down value. Our tax written down value will be what? This plus this, 127,917 plus 42,500 minus 85,209. How much did it give us?
85,208.
85,208.
208. So that will give us 85,208. So in 2018, did we make any payment from our? No payment was made in 2018. So that means in 2018, we have only what? Annual allowance. Then in this 2018 now, this annual allowance, This asset, we are supposed to claim capital allowance for how many years? 25%.
4 years.
4 years. This is what? Year 1, 2015, year 1, 2016, year 2, 2017, year 3. This 2018 happened to be what? The last year.
Last year. Yes.
Yeah. So in the last year, the annual allowance will still be the same value. So we can confirm. So for 2018 now, for 2018, annual allowance will be what? 85,208 divided by, because to 85,208 divided by 4 minus 3. Thank you.
3.
Divided by 4 minus 3. Divided by 4. 4 minus 3. Which will give us how much?
85,208.
85,208. So the same value, 85,208. So annual allowance will be 85,208. Here you have it as what? 85,208. So, and I told you at the end of the useful life, you are going to retain what? Nominal value of how much?
Nominal value. 1%.
Nominal value of what?
1%.
1%. Yes, thank you. 1% of what? 1% of what do we retain? Who can tell us? 1% of what? Of cost, yes. The nominal value will not
of
be
the cost.
Of the cost. 1% of the cost. Which cost are we going to use? Of the cash price. 1% of this cash price. Look at it. 270,000. 1% of this cash price of what? 270,000. So 1% of 270,000 will give us how much?
2,700.
27.
So 2,700. So that will come under what? Under the nominal value column. So this nominal value is just to show that that asset is yet to be what? To be disposed of. So that is the reason for the nominal value, to show that the asset is yet to be disposed of. So that is the reason why what? Why we are having what? The nominal value. So take note of that. So that's the reason why we are having what? The nominal value, which is what? Which is that what? That value that we have. So that nominal value will come under what? Under the nominal value column. Because after this year now, if you go to next year, if you go to 2019 now, tax written down value of this asset will be what? 0. Abi?
Yeah.
Is that not so?
Yes.
It will be 0.
Yes, sir.
But in order to show that this asset is still in existence, nominal value must be what? Indicated at what? 1%, which will be what? So that 1% will show that 1% does not affect your what? Your computation. Unlike in the old tax law where you are going to retain what? 10 naira. Now the 1% does not affect your what? Capital allowance computation. It's only going to what? Going to show that what? You have what? You have that asset is what? Is still what? In existence. So that 1% will be what? Will be kept until what? The asset is disposed by what? By the company. So this is how to what? To compute what? Capital allowance when you have asset that is acquired on what? On hire purchase. When asset is being acquired on hire purchase, so the process of what? Capital allowance will be what? Will be computed based on what? Based on how the payment is being made. So let us take note of that. So where you have what? Capital asset that is acquired on what? So you have what? That. So any question? So you may be giving any of the scenario. It is either the examiner give you asset that is acquired on what? On normal basis, on direct info, or you are giving what? Asset that is acquired on what? Hire purchase. When you are going to be giving asset that will be acquired on hire purchase, the examiner is going to indicate that the asset is acquired on what? On hire purchase. So you can have any of the two scenarios. Instead of the hire purchase, the examiner can also say that the asset is acquired on what? On lease, on what? On finance lease. So if it's acquired on finance lease, the same procedure that you adopt for what? Hire purchase will also be what? Adopted when it is acquired on what? On what? On lease purpose, on what? Finance lease. So let us take note of that. So that is what? When asset is acquired on hire purchase. So those are the analysis or the computation you are expected to know as far as what capital allowance is concerned based on your syllabus. You are expected to know capital allowance based on what? Based on outright purchases and what? Capital allowance acquisition when asset is acquired on hire purchase or on what? Finance lease basis. So let us what? Familiarize ourselves with. The examiner can ask us any of the two scenarios. So that is all we are expected to know for hire purchase. So for capital allowance, so we are moving further to the next topic, which is what? Withholding tax. So we are moving further to the next topic, which is what? Withholding tax. So we have a withholding tax. Under the tax law, we have various taxes that are payable by taxpayer. We have the taxes that are payable on what? On individual income. We have which is called personal income tax in the old tax law, which is payable on individual income. We have the company income tax, which is payable on company income, which is called the company income tax in the old tax law. Then we have other form of taxes, the capital gain tax, which is payable on chargeable gain. We have the value added tax, which is based on consumption of goods and services. So we have a lot of taxes that are payable by taxpayer. These taxes payable by taxpayer, government is looking at a way that taxpayer will not evade those taxes. So in order not for taxpayer to evade those taxes, government introduced what is called withholding tax. Simply put, withholding tax is what? Is an advance payment of tax. That is what? Available as a set-off against what? Subsequent tax liability. It is what? An advance payment of tax. That is what? Collected from where? From payment that is made or payment that is being received from a third party, which will be what? Available as a set-off against subsequent tax liability. Let's say, for instance, those of us that are working, so we are gainfully employed. And you know that for you to be gainfully employed, that means your employer will be paying you what? Salary. And before your employer will pay you the salary, your employer will deduct what is called pay as you earn from those salary. That pay as you earn will be remitted to the relevant tax authority. So let's say that same employee is now blessed with what? Excess fund. This excess fund, you are going to deposit it. So let's say the employee now decided, okay, I want to deposit this money in the bank, in financial institution. So when you deposit in financial institution, they are going to pay you interest. Do you think that if the bank now pay that employee interest, do you think that the employee is going to disclose that interest to his employer? I'm asking us that question now, that those of us that are working now, your employer is going to pay you your salary. You also have other income that you are receiving. Do you think that employee is going to disclose that other income to his employer, that to also be subject to tax? So do you think he's going to disclose? No. No taxpayer will be willing to do that. So because government know that taxpayer will not be willing to disclose some income, they now introduce this withholding tax. So this withholding tax, that income now, before the payer is going to pay you that income, we will deduct that withholding tax. So that is why you see those of us that usually keep our money, if you have a savings account and if you don't operate that savings account for more than 3 times in a month, if you have a balance on the balance that is available in that savings account, the bank is going to pay you what? Interest on that balance. You will see that immediately that interest is entering, you will see what? Another debit alert for withholding tax. So that withholding tax, government is collecting that tax from you in advance, so that what? That income will be what? Will not what? Will not escape the tax net. So that tax they collect from you in advance is what? Is a form of what? Advance payment of tax, which you have a right to what? To use this to what? To reduce your tax liability. So this particular tax scenario is introduced in order to what? To reduce what? The level of what? Tax evasion that is usually what? Embarked upon by taxpayer. It is introduced to what? To reduce what? Tax evasion that is usually carried out by taxpayer. So that's why they introduce what is called what? Withholding tax. And this withholding tax is regulated by what? Is now regulated by what? The withholding tax regulation of what? 2024, which became effective from the 1st of January 2025. And some other provision of what? Of the Nigerian Tax Act. So there were improvements on what? On that withholding tax regulation by what? Which is introduced by what? By the new tax law, which is what? The Nigerian Tax Act. So I said this withholding tax, you are going to use it to reduce your tax liability. In some cases, this withholding tax that you paid may not be available as a set-off against your what? Your subsequent tax liability. In some cases, you cannot use it to reduce your tax liability in some cases. In those cases are regarded as what? They are regarded as what? As final tax in those cases. So some withholding tax are regarded as a final tax in some cases. Those withholding tax that are regarded as final tax in some cases are called what? Frank investment income. So we are still going to talk more on that. So just know that it is not all withholding tax that you suffer that you can use to reduce your subsequent tax liability. So what are now the features of this withholding tax? So payment of withholding tax is statutory on the person making the payment. There is not it's not something that they are going to persuade you. Once the transaction, once you are receiving, you are earning a transaction or an income that is subject to withholding tax. The deduction is what? Is compulsory. It's not a negotiable something. Once that transaction is part of the transaction that is subject to withholding tax, deduction of that tax is what? Is compulsory on what? On the person making the payment. Failure on the person to deduct is an offense that is punishable by what? By a certain provision of what? Of the NTAA, Nigerian Tax Administration Act. So payment of withholding tax is what? Is statutory. It's compulsory on what? On anybody that what? That embark on what? Transaction that attract what? Withholding tax. So withholding tax credit is usually used to offset what? Tax liability. As I said, some of the withholding tax you can use it to reduce your tax liability in subsequent year. Then withholding tax is an advance payment of income tax. Then withholding tax represents final tax on frank investment income. For frank investment income, you cannot use it to reduce your subsequent tax liability. So the withholding tax that is usually suffered by taxpayer are in two forms. So we have two categories of withholding tax that is usually suffered by a taxpayer. We have what? Withholding tax payable and what? Withholding tax claimable. We have two forms of withholding tax. We have the withholding tax payable and the what? Withholding tax claimable. In the case of the first one, withholding tax payable, that is withholding tax deducted on payment made by what? By an agent. Withholding tax deducted from payment made by an agent on payment made to third party. Withholding tax deducted from payment made by an agent to third party. And this withholding tax payable will be deducted on behalf of the relevant tax authority and will be remitted to what? To the relevant tax authority by the agent, which will be available as a claim by what? By the third party. So what do we mean by that? So let me look at that. I'm coming. Just give me some minutes. Okay. I want to be sure that I've saved it. Yeah. So I said that is the withholding tax deducted from payment made to a what? To a third party. So let us look at it. Assuming you have this particular taxpayer, equity professional. Equity professional, we know that they are to provide what? Accounting, provide accounting lectures. This equity professional, let's say they now engage the service of Mr. Kunle to repair table and share at a contract sum of 1,000 naira. Equity professional engage the service of Mr. Kunle to repair table and share at a contract sum of 1,000 naira. Contract sum of 1,000 naira. This table and share we are talking about for those students, for the what? For the physical students, they need what? Table and share that what? Will be used for the purpose of what? Receiving the lectures. Some of the table and share are now 40 or they want to do new ones. They now engage Kunle to do it. It is mandated on what? You know that means payment is going to flow from equity professional to Kunle. It is mandated on equity professional before paying Kunle this 1,000 naira to deduct what? Certain amount of tax based on what? Based on the tax rate. So let's say they now paid. They now finally paid. They finally paid Kunle 900,000 naira. 900 naira after completing the contract. Kunle is supposed to collect what? How much? 1,000. But they end up paying him what? 900 naira. So that 100 naira that is deducted, 100 naira deducted. Who is holding that 100 naira? Who is holding that 100 naira? I want to ask you, who is holding that 100 naira?
Equity professionals.
That 100 naira deducted by equity professional is called what? Is called withholding tax payable. So they are just holding that money. That money is not their money. They are holding it for what? For the relevant tax authority. On behalf of what? On behalf of Kunle. You know, it's part of the income of Kunle, but the government, they want to collect it in advance. So equity professional will now collect that money. So in their book now, it will be what? Withholding tax payable, which they are going to remit to what? To relevant tax authority. So they will remit it to the relevant tax authority. At the end of the useful life, it is expected that that money must be remitted at the end of the financial year. You know, every taxpayer, they prepare their, if you are doing business, it's expected that you prepare your account for a period of what? 12 months. At the end of that year, you are expected to have remitted that money to what? To the tax authority. Where at the end of the year, where the money is yet to be remitted, you know the money is still with what? Equity professional. If equity professional is yet to remit it and they want to prepare their record, they must record it in their account. It must be what? Recorded in their account as what? As a liability. They will now record it what? As a current liability in what? In the statement of financial position. At the end of the year, where it is yet to be remitted, it will be recorded as well as a current liability in the statement of financial position in the book of what? Equity professionals. So that is for what? Withholding tax payable. So we also have the second category of withholding tax, which is called what? Withholding tax claimable, or receivable. Claimable or receivable. This is the amount of withholding tax suffered from payment received from a third party. So the first one is what? Deducted from payment. This one is the one you are suffered. You are suffering from payment you are receiving from where? A third party, which will be what? Available as a setup against what? Subsequent tax liability. Let's say, for instance, also this equity professional. So another company, let's say XYZ Limited, engages equity professional to provide accounting lectures to their employees at a cost of 10,000 naira. At a cost of 10,000 naira. So that means money is going to flow from where? Money is going to float from XYZ. Money is going to move from XYZ to where? To equity professional. To equity professional. It is also expected on XYZ Limited. Before they are going to pay equity professional, it is also expected on them to deduct what? To deduct withholding tax. That withholding tax that is being deducted by XYZ, that is in the hand of XYZ, to equity professional is called what? Withholding tax what? Claimable or receivable. To equity professional is called what? Withholding tax claimable or receivable. So that means what? A single taxpayer can have both withholding tax payable and withholding tax what? Claimable. A taxpayer can have both withholding tax payable and what? Withholding tax claimable. Take note of that. So if at the end of the year, and this withholding tax claimable, equity professional is expected to what? To use it to what? To reduce their tax liability. It is expected that they use it to what? To reduce their tax liability. Where at the end of the year, they are here to what? To claim it. They are here to what? To use it to reduce their tax liability. Where at the end of the year, they are here to use it to what? To reduce their tax liability. At the end of the year, they are here to what? To use it to what? To reduce their tax liability. It is expected that what? They must also record it in their accounts. So recording it in their accounts, they must what? Where they are using it to what? They are here to what? To use it as a claim. They must record it in their account as well as a current asset in the what? In the statement of financial position. So that means a company can have both what? Withholding tax claimable and withholding tax or payable. So they will record one as well. Where they are here to pay, it will be what? Current liability. Where they are here to claim, it will be what? Current asset. Under accounting, under the law, you are not expected to what? To set off them against one another. That is, it is not allowed for you to remove your withholding tax payable from where? From your withholding tax claimable. Take note. You are not expected to what? To remove your withholding tax payable from your withholding tax payable. You are not expected to do that. You cannot remove the withholding tax payable from the withholding tax claimable under the tax law. You cannot set them. So where you have what to pay what is due. If you are here to pay, record it in your account. Where you have what to claim what is due and record it in your account. What the law is saying that, let's say I have 10,000 to pay now, and I have 9,000 to claim. I cannot say, let me review my 9,000 I want to claim from my 10,000 I want to pay. Then I will now end up paying 1,000 to the government. It is not allowed. You cannot set them against one another. They are expected to be treated separately as well, as a separate line item according to what? According to the tax law. Based on what? Based on the law of what? Of withholding tax. So they are expected to be stated separately. So that is for what? For withhold. So those are the two categories of withholding tax. So they are not supposed to work and should not be set off against one another. Evelyn, do you have a question?
Yes, sir. Please, I want to get it right. This in this withholding tax claimable, if SYZ is the one that engaged equity professional, an equity professional, and the SYZ is going to, the money will flow from equity SYZ to equity professional. Am I right, sir?
No. If SYZ engage equity professional, so that means yes, SYZ is going to pay equity professional. Yes,
right. That's what I'm saying. Okay, fine. So if it is expected that SYZ would deduct, you say it's expected that SYZ to deduct withholding tax before remitting to equity professional.
Yes.
Okay, so now the withholding tax claimable in this essence, will it be withholding tax claimable in the hands of equity professionals?
Yes, it will be withholding tax claimable in the hand of equity and withholding tax payable in the hand of
SYZ. Okay.
Yeah.
Thank you, sir.
Do we get it now? It will be payable to one company and claimable to another taxpayer. So to equity professional, it will be what? Withholding tax claimable. And to SYZ, it will be what? Withholding tax payable. Is it clear? So Moses, you raise up your hand. What's your question?
Yes, sir. Good afternoon. Mine is coming from the standpoint of how practicable this works, because I've seen some vendors when we pay them professional fees and deduct withholding tax. One has asked me how can they claim this withholding tax so that they will avoid double taxation. So is there a certificate or something? I just want to
we are still going to talk about that. Yeah, we are still going to talk about that. Now it's even very easier in the sense that you know that most of the tax authorities, they are adopting what? Technology, the use of technology. You that deduct, once you deduct and once you remit it, each taxpayer, they have what? A unique tax ID, which is what? Which is unique to them. They have what? A TIN number. TIN, yes. Or pay ID, depending on what? Whether it is state or federal. So this unique thing, once you make that payment, it will automatically reflect on the portal of that what? Of that taxpayer who suffered what? Who suffered that, who you deducted that particular withholding tax from. Before now, when they were using the manual process, what is applicable is that once you make that payment, the tax authority is going to give you what is called what? A receipt. Like what? That receipt is called what? Withholding tax credit note. A receipt that they will give you that, yes, we have collected this money on behalf of this taxpayer. That money now, that credit note is what that vendor is going to present to what? To the relevant tax authority. That is going to use to what? To reduce the what? To use as what? as the purpose of what? Of set off of what? Of the tax. That it is very simple, very, very simple. In the sense that once you deduct and you have remitted, so the vendor will have what? A receipt, which is called what? Withholding tax credit note. You know, when you make payment, tax authority, the bank will give you a receipt. That receipt is called what? Withholding tax credit note. That receipt is what the vendor is going to use to what? For the purpose of the claim. Is it clear?
Yes, sir.
Yes, sir.
Yes, sir.
So
Thank you, sir.
we have what? Refund of what? Of withholding tax. There may be scenario whereby you have a withholding tax claimable. But because of the nature of the taxpayer, maybe the taxpayer is what? Is exempted from payment of tax, or the taxpayer is not subject to any tax based on what? Based on the occurrence of losses. So the taxpayer, the tax law give the taxpayer a right to request for what? Refund of what? Of any withholding tax that is being made. Either maybe because the taxpayer is what? Exempted from tax, or because what? They don't have what? Tax to be paid. This refund of taxes can either be what? In the form of what? Subsequent tax credits, or in the form of what? A refund of what? In form of cash, which will be what? Credited to what? To the bank account of what? Of the taxpayer. So this refund, according to the tax law, is expected to be what? To be settled to the taxpayer within what? 3 months, 90 days. Within 90 days, 3 months. After it has been established that what? The taxpayer is what? Is what is entitled to that refund. Not 90 days after you have filed your what? You have filed for the refund. Though. After you have filed for the refund, the tax authority will also carry out their own work. Their own, the taxpayer is also what? Is also entitled to what? To the refund genuinely. So when that is established, the tax authority, they have within 90 days to what? To refund the taxpayer. So, and this refund, as I said, can either be in the form of what? Payment of cash through or transfer to what? To the bank account of the taxpayer. Or if the taxpayer is a taxpayer that will be subject to what? Subsequent tax liability, they can use it to what? To reduce what? Their tax liability in subsequent years. So but you need to know that one, according to section 56 of NTA, the ones of the decision of the tax authority to that the refund is genuine. Then also we have what is called what? So if I deduct withholding tax now, I need to know that where do I remit the withholding tax to? Where do I remit the withholding tax to? I need to know where do I remit the withholding tax to? We need to know where do we remit the withholding tax to. Because we have various tax authority, so we need to know where the withholding tax will be remitted to. Is it going to be remitted to NRS or to state internal revenue or some other relevant tax authority, depending on what? On who the withholding tax is being deducted from. So the first one, the withholding tax that you deducted from payment you are making to a company, where the person that is suffering that withholding tax is a company. Any payment that relate to company, the withholding tax deducted from them is remitted to what? NRS, which is formerly the Federal Inland Revenue Service. So any payment deducted from company is remitted to what? To NRS. Any payment deducted from company is remitted to NRS. So any payment you are deducting from company, the withholding tax will be what? Remitted to NRS. So let us take note of that. So the withholding tax will be what? Remitted to NRS. Then where the taxpayer, the withholding tax deducted from payments, withholding tax deducted from payments made to withholding tax deducted from payments made to individual, partners in a partnership business, trustee in a trust and settlement, unincorporated companies. All this category of taxpayer, basically those taxpayers that are what? Individual, sole proprietorship, joint venture, enterprise, all this category of taxpayer. Any withholding tax deducted from them will be remitted to what? To their state internal revenue service. Any state internal revenue service of their residents. Take note of that. All those categories, withholding tax, because their tax is expected to be paid to their state of residence. So withholding tax deducted from them will be what? Remitted to state internal revenue service of their resident. Then withholding tax deducted from the resident of FCT Abuja. Resident of FCT Abuja, any withholding tax deducted from those are what? Are payable to what? To FCT IRS. We have an FCT Federal Capital Territory Internal Revenue Service, which is what? An internal revenue service under Nigerian Revenue Service. That internal revenue service is what? It's a body under what? The NRS. So all the residents of FCT, their withholding tax will be remitted to FCT IRS. Then for payment due to what? Deducted from payment due to members of the Nigerian Armed Forces, members of the police, Nigerian Police Force, members of the what? Other paramilitary members, and what? Members of the Foreign Affairs what? Foreign Affairs Service. All these are what? Remitted to what? To Nigeria Revenue Service. Then any withholding tax deducted from payment made to what? Non-resident, whether non-resident individual or non-resident or company, they are remitted to what? To Nigerian Revenue Service. So basically, the tax administration for the what? For the remittance of withholding tax lies between what? NRS, FCT, IRS, and what? State Internal Revenue Service. So those are the various relevant tax authority for the deduction of what? Of withholding tax. Then Moses.
This Nigerian police and members of the armed forces.
Armed forces, yes.
I think I read somewhere they said they are exempted from paying any form of tax, withholding anything. I don't know if that information is correct.
It's not correct.
Recently, I read somewhere. I just want to confirm from you.
Are they not part of citizen?
Yes, I also read from somewhere.
Like they exempted members of the armed forces. The new tax.
Yes.
It was said in class. I think
yes,
it was said in class.
I read it also.
In the new tax law,
military.
Military, it is Nigerian military. Military, not the police. Hello, it's not the military. Police is the Nigeria, not the police, sorry, is the what? The military. When they say armed forces is not only the military. Under the armed forces, you have the what? Who can tell us? Under the armed forces, we have what?
We have the Air Force.
Yes, we have the Air Force. We have the Navy. We have the Air Force. We have the Navy. We have all those categories. The only one that are exempted is what?
The military.
The military. Take note of that. The military. Others are what? Are subject to tax. Does that clarify your question?
Yes, I does. Thank you.
Yeah. So when they say armed forces, it's not only military. So we have all of them embedded in it. So out of them, it is only what? The military that is what? Exempted based on what? The new tax law. So we now have, we now have transaction or income that are subject to what? Withholding tax. Please, based on the new withholding tax regulation, the rate has now been what? Divided into what? Resident and non-resident, depending on what? On the nature of the taxpayer. And take note that this rate will not be provided to us by the examiner. This withholding tax rate will not be given to us by the examiner. It is expected that we must know the what? This rate for the purpose of the exam. Lovette, you raise up your hand.
Yes. So I just want to ask that for this parliamentary that they say that they are exempted from the tax, whatever. So, sir, is it? I thought it's only payee that they are exempted from paying. Pay as you earn.
Yeah. Let me, even when they say exempted from tax, any form of tax, as an individual, you know, when we started this form of tax, I told you that this withholding tax is not another form of tax. It is what? Advance payment of tax. This tax they want to deduct is part of your payee that you are supposed to pay. But they are what? Deducting it in advance. It is still part of the payee that is exempted from tax. But the law is what? Is collecting it what? In advance from the taxpayer. So what you are paying in form of this withholding tax is also part of your payee that you are supposed to pay. But government, in order for you not to work, in order for that income not to escape the tax net, government is collecting part of that payee in form of what? Withholding tax. When they now want to, when the time now comes for you to pay the payee, they will now calculate the payee that is you are supposed to pay on that income appropriately and remove anything that has been deducted in form of what? Withholding tax. So when they say exempted from tax, it's not only what? The personal income tax. Part of this tax that you also expected, part of what they are deducting as part of withholding tax is also your pay that you are supposed to pay. Then we have those income and transactions that are subject to withholding tax. And I said the tax law, the examiner expects us to know this rate because it will not be given to us by the examiner for the purpose of our exam. The rate are stated below. As I said, we have the rate for resident and non-resident. Some of them are the same, depending on what? On the nature of the taxpayer. Then we have a dividend and interest all through the taxpayer, whether company, resident or non-resident. They are what? At the rate of what? 10%. Then we have royalty for company, resident and non-resident, 10%. Then while for individual, we have 5%. Rent, hire, and lease payment. Maybe rent, hire of what? Hire of equipment, any form of hire of motor vehicle. So we have what? 10% to wrap. Please, when they say hire of motor vehicle, so what they mean by that, it is not when you engage the service of an Uber. So that is not a contract. You know, there are some taxpayer, there are some companies, there are some taxpayer that the nature of their work is to provide logistics, to provide fleet of cars. When you now hire any of those vehicles from them, you are going to pay. So it is expected that withholding tax should be deducted, provided you are an agent for deduction. So not when you engage the service of an Uber. Don't go and fight with Uber man and say, your lecturer told you that when I hire motor vehicle, I should deduct withholding tax. So those are those that are involved in logistic services. Then we have commission, consultancy, technical, management, and professional fee. For residents, both individual 5%, and for non-resident 10%. That is all. In the case of audit firm, professional firm, and so on and so forth. Supply of goods or material other than by the manufacturer or producer. So when you are supplying, if you are not the manufacturer, let's say you are the wholesaler now, any supply you made, resident 2%, non-resident not applicable. Then individual, resident 2%, non-resident not applicable. You can see that for the non-resident, you have a non-applicable. It is expected that when you want to supply an item from outside the country, that item will be subject, because you that you want to supply that item, you are Because you are not in Nigeria, that makes you not to be what? A resident of Nigeria. And for you to bring an item into Nigeria to supply a goods into Nigeria, that goods will be subject to what? To custom duty. So there is no way that item is going to what? Escape what? The tax net. And this tax you want to collect now is what? Tax that is based on your own income. So because you are a non-resident, you may not be what? A resident of Nigeria. That is where you have what? Not available. So we have Balikis.
Okay, good morning, sir. I just want to, this supply of goods or materials other than by the manufacturer
or producer, yes.
I have a question on that. So I was reading somewhere, somebody was asking if you should charge withholding tax on a Gary invoice. Maybe somebody that sold Gary to you. That should you charge withholding tax on that kind of invoice?
No.
Then
who can help us answer that question?
I'm still, yes. Then I was not seeing it somewhere that they now answered that we are not going to charge withholding tax on it because it's a basic food item or something like that. That the only exception is they were not saying something about over-the-counter sale, whether it's an over-the-counter sale or if it's the producer or manufacturer. So I'm not very clear on it. So I'm seeing producer or manufacturer here also. I don't know if you can elaborate on the reason why we are not charging withholding tax on that.
I heard somebody saying no when you said Gary before. Who was that person?
Okay.
I want to hear the response of that person. Somebody was saying no.
Hello,
Who
sir.
was the person? Okay.
Hello. In my own opinion, since Gary is like a raw material, it's like a local product that has not been repackaged, they won't charge any withholding. But if it has been reprocessed and repackaged, like just that's seaway water.
Okay.
Mm-hmm. If it has been reprocessed and repackaged, they will charge withholding it. That's my own opinion, sir. Yes.
One thing is that the question you are asking, looking at the question, I can see that you are mixing up withholding tax with VAT. When you said exemption, there are some items that are exempted from VAT. Withholding tax is specifically different from VAT. Shioma, you raise up your hand. You wanted to say something?
No, I wasn't close to my this when you were asking who was saying the no. I said no. So
okay, what you wanted to say something?
It's the explanation that you're giving now because there are input and output VAT.
Output VAT, yes.
Yes, so Gary is part of the tax you pay the input VAT on.
So what I noticed is that the question you wanted to ask relates to VAT. We have what? Items that are exempted from VAT. So we are not talking of VAT here. What we are talking of is what? Withholding tax. Let me say, this withholding tax is what? Income that taxpayer is going to receive. Their income that they are going to pay tax on. You are collecting that tax on that income in advance. Income. Look at that word, income. That you are what? You are going, that will be subject to tax. You are what? You are collecting tax on that income in advance. So now to this question now. Supply of goods or material other than by the manufacturer or producer. The law believes that if you are the manufacturer of an item and you are the one supplying, that item you are supplying constitutes your what? Your turnover. That is your major turnover, which you are still going to end up paying what? Tax on it. At the end of what? At the end of what? Your financial record, which you are going to prepare your account. In order for the government not to cause cash flow problem for that particular taxpayer. So that is the reason why what? They are exempting what? The manufacturer. If you are the manufacturer of that product, If you sell that product is going to be your what? Turnover, is your sales. And that sales, you are still going to pay what? If you are company, you are still going to pay company income tax on it. If you are individual, that will form your income after removing all your expenses. You are still going to pay what? Personal income tax on. And you are engaged in what? Business. In order not to burden you and to cause cash flow problem for you, government is exempting you from that what? Paying that tax in advance, because they know that what? You are still going to declare that what? That income. It will have been a different case that you are not the manufacturer now. You are a what? A wholesaler or a retailer. So that means you are not the one producing that item. You went to what? To the manufacturer to go to buy it. After buying it, you too, you add your what? You add your own what? Your own profit margin, Abi, to that item. When you add your profit margin to that item, because you are not the manufacturer, it is possible for that item to escape what? To escape the tax net, because you are not the manufacturer. So that is the reason why what? That item is being subject to what? To withholding tax. Why the one that is manufactured by what? By the manufacturer directly is being what? Exempted from where? From withholding tax. So basically, there is a difference between what? VAT and withholding tax. So when you are talking of VAT now, that's when you now be talking of, okay, Gari is what? Is an exempted item. So if you are talking of withholding tax, if you are supplying Gari, if you are the manufacturer of that Gari, because that Gari you are supplying, you are the manufacturer, anybody that buys that Gari from you is not going to deduct withholding tax, because you are still going to end up what? Paying what? Tax on that what? Income. But if you are not the manufacturer, you are somebody has already manufactured that Gari, you are just what? You are a wholesaler. That Gari you are selling, any income that you made from that Gari is going to be what? Income that is going to be subject to tax. And that income, because it's going to be subject to tax, government want to collect what? That tax from you in advance in form of what? Withholding tax. So if you are looking at Gari now, if you use this VAT, Gari is for part of what? The basic food item, which are what? Exempted from VAT. So that's why it will not be subject to value added tax. So whether the form of what? Transaction you are supplying, once you are receiving an income, and that income, if you are receiving it and you are not the manufacturer, that income will be subject to what? To withholding tax. Once what? There is established what? There is what? A contract. So we are still going to talk of what they now mean by what? Contract of so. Once there is what? A contract between you and what? And the buyer. It's a different case now, that because part of that is what? There are items that what? That are exempted, which is what? Across the counter. So which is, after we do this, I'm going to explain that as well. So that is on that. Then we have what? Collation and telecommunication tower service. All this mask that are usually erected for residents, individual and company 2%, for non-resident 5%, individual and company. Supply or rendering of services. You can see when you are supplying an item or you are rendering what? A services now. Supply. Now you can now see the difference now. So that means if you want to supply, so that means there is what? There's going to be what? A contract between what? You and what? You and the person, for you to say you want to supply somebody. So contract of supply. For any contract that you are entering into to supply, not in the case of somebody coming to your office to come and buy. So for supply, you have a 2% for resident, 5% for non-resident. The construction of road, bridges, and what? Power plant. Construction of road, bridges, and power plant. 2% for resident, 5% for non-resident. Then any other form of construction, apart from what? Road, any other form of construction apart from road, bridges, building, and power plant, 5% for resident, 10% for non-resident. Brokerage fee, a broker insurance business, resident. So any fee you receive from as a result of what? Being a broker. For resident, 5%, non-resident, 10%. Then director fee, you can see under company, you have what? Not applicable, NA for company. Then for for individual, resident, 15%, non-resident, 20%. So you may now look at it that why do we have not applicable for company? It is expected that director of an entity, of a business, must be an individual. Even though if it is company that is what? Investing in that one, in another company. Who are the what? Who are the director of those companies? An artificial person cannot what? Invest on his own. There must be people governing what to making that decision. So that's why you have what? Not applicable under what? Company and what? 15% and 20% for individual. That's only applicable to individual. Compensation for loss of office for company dash, for individual 10% and 10% for both resident and non-resident, which is what? For compensation above what? Above 10%. Entertainment and sports person, you can see that you have only what? Under non-resident, 15% for both what? Company and individual. The government, they find out that they notice that a lot of foreign entertainers, musicians, footballers, all these entertainers, they come to Nigeria to come and cash out. After cashing out, they just move away with that money without paying anything, because they are non-resident. So in order to collect part of the share, for you to come to another land to collect part of the share for them, so government are now making that was compulsory on non-resident. The reason why the resident one are not applicable is that they know that as a resident, you are already a resident. That's doing. You are still going to end up paying tax to the government from the totality of all your income at the end of a particular year. So that is why you have it as not applicable. Then we have winning from lottery, gaming, and reality show. Like winning from where? From Bet Nigeria, from all these bets, winning from a reality show, like what? Winning from Big Brother, from any other reality show or lottery. So you can see that you have only individual, 5% and 15% in the case of individual. So those are the transactions and income that are subject to withholding tax. So when you see any of these transactions, they are to be subject to withholding tax. So take note of that. Then as we have that, we also have those transactions that are exempted from withholding tax. Transaction exempted from withholding. So this is where I'm now going to explain that other one again now. We have across the counter transaction. So under here, when we look at transactions subject to withholding tax, we say supply of goods or material other than by the manufacturer. If you go to a manufacturer now to go and buy, this across the counter now. Instead of saying, okay, give me a contract to supply me this item, I want you to supply me. You went to the market yourself to go and buy that item on cash and carry. There is no contract between you and what? You and the seller. You went to whether his workshop or where the goods are being displayed to go and buy. That's what across the counter. There is no contract between you. So that such will not be liable to withholding tax. Then we have a goods manufacturer or material produced by person making the supply. So this will buttress more point on this now. On what? Supply of goods or material other than by manufacturer or producer. So when you are the manufacturer of that item, it is exempted from withholding tax. So that is why you see that under the non-resident you have not applicable. Why you have other than manufacturer or producer, because it is exempted. The one that is produced by the manufacturer themselves, It's going to form part of their turnover, and it is part of what? Exemption from withholding tax. Imported goods, where the transaction does not create a taxable present in Nigeria for the supplier. You are importing an item, and you are not what? You are not liable to pay tax in Nigeria. That is also the reason why you have what? Not applicable here for non-resident under what? This supply of goods or material. Because of that item is what? Is exempted by what? By the tax law. Interest and fees paid by a Nigerian bank by way of direct debit of funds which are domiciled in the bank. So interest through what? By way of what? Direct debit of funds. So you debited fund directly by yourself. So into your fund, into your account. So such income is not subject to any withholding tax because you are paying what? Income, part of your income that is expected to be subject to tax. So when you are depositing in the bank, so they are not going to say what? Come and pay what? Withholding tax for those deposits. Then income or profits exempted from tax. So any income that is exempted from tax, out-of-pocket expenses that is normally expected to be incurred directly by the supplier. So which is not part of your contract fee. Any expense that is not part of your income or not part of your contract fee. Maybe you want to do an item now, but you need to buy some item and you are now charging for your own service. So what is going to be liable to withholding tax will be what? Your own what? Income, not the item you are buying. Because the item you are buying is what? Across the counter, you are not supplying them. The supply of what? Any form of what? Petroleum products are also exempted from it, like your supply of diesel. So if it's anybody that supply you diesel, you are not expected to deduct withholding tax or petrol. Any distribution or dividend payment to a real estate investment company, so provided under section. So because that distribution as a dividend or that income is part of what? The normal income of what? Of that real estate. A real estate, what they do is what? They sell what? They sell their what? Their real estate, their property. So that rent you want to distribute to them, or that dividend you want to distribute has already been subject to tax under what? Under their what? Their tax, company income tax. Compensating payment under what? Security exchange lending. So any compensation from a security lending is also commission retained by a broker from money what? Collected on behalf of the principal. Because the broker, the money he collects for his principal, the broker is not the owner of that money. So the broker is not the owner of that money. Any money he collects is not what? Is not subject to what? Is not subject to withholding tax. So because that money is collected on behalf of the principal, that money belongs to the principal. Then winning from a game of chance or reality show with content designed exclusively to promote what? Entrepreneurship, academic, technological, or scientific innovation. If it is to what? To develop, so you are embarking on what? On a what? A quiz to develop what? The knowledge of people by academic. So any winning from there is not going to be what? It's not going to be liable to withholding tax because you are adding more to knowledge, not the one you are gaining from other reality shows, such like what? From Big Brother and other. Then regulatory fee paid to government agency. So because the agency is also part of what? The money, this withholding tax you want to pay, you are paying it to the government. And in order not to what? Cause bureaucracy. So when you are paying what? You are paying SEC, you are paying CBN. They are also what? They are already part government what? Money. They are already government agency. You don't need to deduct what? Government that is already going to what? Their agency for them. Then telephone charges, internet data, and what? Airline tickets. So all those are exempted from withholding. Then any payment in respect of income or profit which is exempted from tax. So they are also exempted from it. So all those are items that are exempted from withholding tax. So when you now look at this item now, so let us look at what do we mean by contract of supply. So contract of supply cover all forms of supply delivery, or like through competitive bidding, lender arrangement, whether oral or written. Anything that involves you to say, okay, to enter into an agreement, whether that agreement is written in form or is stated through oral form, that, okay, supply me this, is regarded as a contract of supply. Contract of supply does not include a scenario whereby you walk up to a shop and to go and buy something. There is no agreement between you and the seller, because the seller has already displayed the item to everybody. So there is no agreement between. So the term does not cover across the counter cash sales or supply in ordinary course of sales. So any supply in ordinary course of sales that you just went to the market to go and buy does not constitute a contract or supply. So contract, which is outright sales or purchase of goods and property in the ordinary course, are exempted from withholding tax. So as I said, so that's why you have this exemption across the counter and goods manufactured or produced by the person making the payment. So if I now enter into any of these transactions that is subject to withholding tax, how do I know that I'm part of the taxpayer that are exempted to deduct? So if I want to pay somebody now, interest now, maybe I borrow him money, or I want to pay rent. Good example is rent. Because almost everybody pay rent. I want to pay rent to my landlord now. How do I know that, okay, I'm supposed to deduct withholding tax or not? So deduction of the withholding tax lie on the following people, eligible people. A body, corporate or unincorporated, other than an individual. Look at that word, a body, corporate or unincorporated, other than an individual. What that means is that people that can deduct withholding tax are those that are engaged in what? Business. Those that are engaged in business activities, that are keeping record of, because by the tax law, according to the law, if you establish a business, you must keep record of your business transaction. So anybody that is going to deduct withholding tax must be those that are engaged in what? In business, either as a company or as an individual, as an enterprise, a sole trader, a joint venture. So you must deduct withholding tax other than an individual. That means you and I, that we are not doing business. You and I, that what we do is that we are working for another company. We cannot deduct withholding tax, because we are not part of the agent to deduct withholding tax. So that means you and I, that you are not doing business. If you are paying your landlord, you cannot say you want to deduct. Who is that now? You cannot say you want to deduct withholding tax from payment you are making to your landlord, because you are not keeping record of your transaction. So you are not keeping record of your transaction. You cannot deduct withholding tax from that item. Because Abiodun, mute your mic. Hello, Abiodun, mute your mic. So because you are not keeping record of your transaction, by law, you cannot deduct withholding tax. So you and I, that you are not engaged in business activity, we cannot if you want to pay your landlord, you cannot deduct or withhold. So you must pay your landlord in full. It's only those that are engaged in business activity as a body, either as an individual or body corporate, because government will be able to trace that transaction, because they keep record of the but you and I, we don't keep record of our record is in our hand. You know how much will come to your account at the end of the month. So how you spend it is on your head or in your rough book. So you don't keep record of your transaction. Yeah, Evelyn.
Yes, sir. For that landlord, say for instance, I own a bank. I lease a place from a landlord. Do I fall under the corporate that will deduct before I give my landlord the balance?
Yes, now, because for you to own a bank, you must register. Okay. You must register that bank as a corporate entity. Okay. So in that case, so that bank, that makes you to fall as agent to deduct withholding tax. So you are going to deduct withholding tax before paying that landlord the lease amount.
Okay, say for instance, I own, maybe not a bank, I own a company, maybe that deals in manufacturing of items.
Whether company or anything, once you are doing business, once you are doing business, you must deduct.
Yeah. Okay.
Whether as a business, as a company, or as an individual. You know, it is not only company that is doing business.
Yes.
Also, individual, they also do business as what? Enterprise. As joint venture. As sole proprietorship. You are also expected to deduct.
Okay. But in reality, it's not achievable. Say for instance,
Why is it not achievable?
Okay, like your landlord is saying your yearly payment, you own a shop where you sell foams as in mattresses, for instance, and your yearly payment is 1.2 million, for instance. Normally, you're supposed to remove the withholding tax before you pay him the balance, but landlords will not agree for you to remove it. They expect you to pay them full.
In that instant that you are saying, okay, you are selling a foam. That foam, for selling that foam, you too, that you want to deduct, do you keep record? Do you prepare accounts at the end of the year?
Yes, in this scenario, yes.
If you prepare accounts at the end of the year, you are mandated to deduct. But when issue normally arises, that some landlord will tell you that you are not expected to deduct. You cannot. My money must be complete. I don't send you to. Yes. When your landlord said that the honors of that payment is on you, that payment will be what? Will be a burden to the company, to that taxpayer. It's going to be what? Additional cost to the taxpayer.
Okay.
It's going to be an additional cost to the taxpayer. So once you keep record of your transaction, you are expected to deduct. Because if tax authority come, it's not an excuse that my landlord say I must. So they are going to ask you for the money. So that amount now will not be what? A burden to you that you have to what? That you have to bear as part of your rent.
But scenario like that, can't we just report somebody like that to the tax authority, let them carry out what they are supposed to do? Because if you have to, you must pay these people, because if not, they will threaten you, they will give you quick notice.
But they will even give you quick notice.
Now that is the reason why I said pay him his full money. That we are still going to talk about it. There is something that the law says about that okay, you are supposed to pay somebody, but you did not pay. You not pay him the full money. No problem. Paying his full money. When the law comes, there is a way that they are going to look at it. Is it as a result of your own fault or the fault of what? Of that person? But pay him his full money in order to save your own what? To save your own end. So pay him the full money. But what the law is, that money is either going to constitute, you know that when the tax authority, when they now come, they now say, okay, yes, come and pay that money. So that means instead of paying, you are supposed to pay him 1 million. You now say, don't remove any 10%. Pay me my 1 million. You have now paid him 1 million. When the law came, they now said, where is the 10%, which is 100,000. So that means your rent has now moved from 1 million to 1.1. That 100,000 is going to be additional cost that the company is going to bear. There is a way to it. The law is not going to go over that after that person, but I don't want to explain it now. So when we get to that place, so we are going to talk more on it. Then we have a government ministry or department. Any ministry of the government are also mandated. They can also deduct. A statutory body, any statutory body, whether as a club, as a restaurant, or any statutory body, as a church, or so they are also expected. A public authority, so whether local government or any other government authority, any other institutional enterprise or organ, including those exempted from tax. Even though if you are exempted from tax, you are also mandated by law to what? To deduct what? Withholding tax. The fact that you are exempted does not make you not to what? Deduct withholding tax. Then a payment agent in respect of those mentioned above. If you are acting as agent to any of those people that are mentioned above, you are also exempted from it. You are also expected to deduct what? Withholding tax. Then the law now says small business as defined by what? Under section 209 of what NTA are exempted from a requirement to deduct what withholding tax, provided there is a condition, provided that what the taxpayer is having a valid TIN and what the transaction with one supplier does not exceed 2 million naira in a calendar month. The tax law says that for small business, they are said even though if you are exempted from tax, by law, small business are what they are exempted from tax. Small business are business with what, according to the NTA, they are business with annual turnover of what 100 million naira and below, with a what a fixed asset of what 250 million, with a qualifying fixed asset of what 250 million. They are called what small business. This small business they are exempted from payment of tax. That does not exempted from deducting withholding tax. But the law now says further that what if you are a small business under the law is giving you opportunity. They don't want to bother you too much. Don't deduct withholding tax. But there is a condition for you not to deduct if you are a small business. The reason why you will not deduct is that provided that that person that is supplying you, that your vendor or your supplier, is a vendor that is having a valid TIN. For you to have a valid TIN, that means you are already what? On the tax net of what? Of the government. If you don't have a valid TIN and you are dealing with a small business, that small business must what? Deduct withholding tax. The reason for that is that because if you don't have a valid TIN, if that small business you do business with you, there is no way the government is going to track that transaction. It will be difficult for them to get hold of that taxpayer. So as a result of that, that is the reason why you must withhold, provided that vendor is having a valid TIN, and the transaction amount without a single vendor in a month does not exceed 2 million naira. If you are dealing with a vendor and in a month, throughout that month, the vendor is going to supply, it does not exceed 2 million naira. So you cannot deduct. But where it exceeds that 2 million naira, you are expected to deduct as a small company. So that means, in effect, individual and organization not stated above cannot deduct withholding tax when making payment. That means you and I, individual, you and me now, that we are not doing business. We are not, so we cannot deduct withholding tax when we are making payment to third party. So those are the agents or people that are expected to deduct withholding tax. So let us take note of it. Any question? Any question? So this is where we are going to stop the class today. So we are going to continue from the remittance of withholding tax and look at the other aspects. So before we go to the computation aspect. So the absence of no question. So next class. So Moses, what happened? Oh yeah, speak now. Okay.
No, I'm just giving you a thumbs up for your job well done. Okay, thank you, sir. Yes, sir.
Okay, thank you. All right. Okay. All right. Thank you. Take care of yourself and have a lovely day ahead. So I'm going to share this thing to the group.
Thank you, sir.
You're welcome.
All right, sir. Thank you, sir.